The idea landed like a shockwave through an otherwise invisible system. A proposal to cap credit card interest rates at 10% didn't sound radical to most households. To millions carrying balances at 20, 25, even 30%, it sounded like relief. Here's what nobody tells you. Credit card rates are not just prices. They are load-bearing beams inside modern consumer finance. If this pattern applies, then touching them doesn't just change what borrowers pay, it changes who gets access, how risk is priced, and where losses are pushed when the math stops working. At first, it sounded like consumer protection. Then the bill arrived. In the 1970s, rate caps reshaped lending markets across multiple states. In the 1980s, deregulation sent rates higher, but expanded access dramatically. In the aftermath of 2008, defaults surged, yet rates stayed elevated as buffers. The unresolved question isn't whether lower rates feel fair. It's whether the system underneath can survive a hard ceiling without breaking somewhere else. This is where the pattern begins. Credit cards didn't start as profit engines. In the 1950s and 1960s, they were convenience tools for affluent consumers, often paid off monthly. Interest rates existed, but balances were small and defaults limited. That changed in the 1970s as inflation surged into double digits. States imposed usury laws capping rates, but inflation blew through those ceilings. Banks faced a choice: lend at capped rates and lose money, or stop lending altogether. The result was fragmentation. Credit dried up in high inflation states. Access shrank. Here's why this matters. When price controls collide with risk, the market doesn't comply. It withdraws. The modern system took shape after a pivotal shift. In 1978, a Supreme Court decision allowed banks to export interest rates from their home states nationwide. States with higher or no caps became hubs. Rates rose. Access exploded. Credit cards spread across income levels. Defaults were absorbed by higher interest margins. Not charity. Risk pricing. By the 1990s and 2000s, revolving consumer credit became a pillar of household finance. Rewards programs, teaser rates, and balance transfers masked the core reality. Interest paid by a minority of borrowers subsidized the entire system. Here's the mechanism. Those who carry balances fund the rewards of those who don't. By the 2010s, this structure was fully normalized. Average credit card APRs climbed above 20%. Penalty rates exceeded 29%. From the outside, it looked predatory. From inside bank balance sheets, it looked defensive. Charge-offs were constant. Losses were baked in. According to some analysts, a significant share of card portfolios hovered near break, even once defaults, fraud, and servicing costs were included. High rates weren't just profit, they were insurance. So when the idea of a 10% cap entered the conversation, panic wasn't about optics. It was about math. At first, it looked like a political statement. Then internal models lit up. Everyone thought banks were panicking over greed. They weren't. They were panicking over survival of the model. Here's what nobody tells you. A hard cap below risk-adjusted pricing doesn't compress margins. It erases them. Historically, rate caps produce predictable reactions. Lending tightens. Credit scores matter more. Fees proliferate. In states and countries where strict caps were imposed, unsecured credit shrank sharply, not because demand disappeared, because supply couldn't clear. According to some economists, lenders responded by raising annual fees, cutting limits, or exiting segments entirely. Not generosity. Substitution. This is where the promise meets reality. A 10% cap would lower costs for prime borrowers who already qualify for low rates. But subprime and near-prime borrowers, those statistically most likely to carry balances, would face a different outcome. Credit lines reduced. Accounts closed. New approvals denied. Not relief. Exclusion. The danger wasn't what people saw. It was what they ignored. Banks reacted quickly in simulations. Revenue projections collapsed under capped scenarios. Loss absorption vanished. Capital allocation shifted. According to one scenario discussed by analysts, issuers would prioritize secured lending, installment products, or fee-based services. Credit cards would become boutique products again. Fewer people, higher thresholds, less forgiveness. This is where the emotional reaction inside banks mattered. Panic wasn't about profits alone. It was about cascading constraints. At first, it looked like a simple fix. Lower the rate, help consumers. Then the bill arrived in complexity. Credit cards don't exist in isolation. They feed retail spending, smooth income volatility, and act as emergency liquidity. remove or restrict them, and stress shifts elsewhere. Payday lending grows. BNPL expands. Informal credit fills gaps. Not less debt. Different debt. Here's why this matters. Systems don't eliminate demand. They redirect it. When access narrows, risk doesn't vanish. It concentrates. The same households needing credit will find it under worse terms, less transparency, or higher penalties. This is where the pattern repeats. Well-intentioned controls collide with behavioral reality. Markets picked up on this tension immediately. Bank stocks reacted. Analysts revised outlooks. According to some interpretations, the fear wasn't imminent implementation. It was precedent. Once a ceiling is introduced, even hypothetically, expectations shift. Risk pricing becomes political. Models become unstable. Lending becomes cautious. Everyone thought the threat was the cap itself. It wasn't. It was uncertainty. Here's what nobody tells you. Credit card rates are not set because banks can. They are set because losses force them. Fraud, defaults, chargebacks, and regulatory costs accumulate quietly. High APRs offset invisible drains. Cap the visible number without addressing the drains, and something else must give. Fees rise. Access falls. Innovation stalls. This is where the narrative splits. To consumers drowning in interest, a cap feels like justice. To banks managing probabilistic losses across millions of accounts, it feels like forced mispricing. Not morality. Mechanics. And mechanics don't negotiate. By the end of this first phase, the proposal had already done its work. It exposed how fragile the system beneath everyday plastic really is. It revealed how much modern consumption depends on expensive, unsecured credit, and it forced a question no one wanted to ask out loud. If interest rates were capped tomorrow, who would still be allowed to borrow? The answer doesn't sit with banks alone. It sits in how the system responds when a pressure valve is sealed shut. Because when one outlet closes, pressure doesn't disappear. It looks for another way out. And that's where the real consequences begin. The second act begins where the pressure builds, not in boardrooms, but in balance sheets across the country. Here's the mechanism. Credit card lending survives on probability, not certainty. Every swipe is priced against the likelihood of default, fraud, late payment, and regulatory friction. High interest rates aren't charged because every borrower is risky. They're charged because a minority will fail, and their failure must be absorbed by the system without collapsing it. Cap that price, and the probability doesn't change. The arithmetic does. At first, it looked like banks could adapt easily. Cut executive pay, trim rewards, absorb the hit. But that narrative collapses under scale. According to some analysts, credit card portfolios are among the most volatile assets banks hold. Losses spike quickly during downturns. In 2009, U.S. credit card charge-off rates exceeded 10%. Not because borrowers suddenly became reckless, but because unemployment surged and income vanished. High APRs acted as shock absorbers. Remove them, and losses hit capital directly. This is where the pattern becomes clear. When risk can't be priced openly, it gets priced indirectly. Annual fees rise. Late fees multiply. Grace periods shrink. Credit limits tighten. Approval algorithms harden. Not higher rates. Fewer chances. According to one scenario modeled by consumer finance researchers, a strict 10% cap would push millions of marginal borrowers out of eligibility entirely. Not punished. Excluded. Here's what nobody tells you. Exclusion doesn't feel like protection. It feels like abandonment. Households denied credit don't suddenly stop needing it. Emergencies still happen. Paychecks still fluctuate. Medical bills still arrive. The demand for short-term liquidity doesn't disappear. It migrates. Buy now, pay later plans expand. Installment lenders step in. Informal lending grows. Often at higher effective costs, but with less transparency. Not safety. Substitution. This is where the trap snaps shut. Consumers celebrate lower headline rates, while access quietly contracts. Those who already had strong credit benefit most. Those already strained lose flexibility. The system becomes cleaner on paper and harsher in practice. Not fairness. Sorting. Banks respond rationally. They shift toward secured products where losses can be recovered. Auto lending, mortgages, and installment loans become priorities. Credit cards revert toward their original function, tools for the financially stable. Rewards programs shrink. Credit limits compress. Innovation slows. According to conditional assessments, the market becomes safer but smaller, less volatile, less inclusive. Meanwhile, political pressure doesn't vanish. If credit tightens, calls for intervention grow louder. Fee caps are proposed. New rules are layered on top of old ones. Compliance costs rise. Smaller banks exit. Large institutions consolidate. Not competition. Concentration. This is where power structures quietly realign. Regulation intended to curb dominance can unintentionally reinforce it. Markets read these signals quickly. Investors price in regulatory risk. Lending multiples compress. Capital flows toward less exposed sectors. According to some economists, the long-term effect isn't a banking crisis, but a revaluation of consumer credit as a growth engine. Consumption slows at the margin. Retail feels it. Employment follows. Not collapse. Drag. Here's why this matters. Credit cards are not just financial products. They are behavioral scaffolding. They allow households to smooth spending, absorb shocks and bridge gaps, remove or restrict them abruptly, and volatility moves downstream. Defaults don't vanish, they cluster. Stress concentrates in fewer channels. There are alternative paths. One scenario suggests pairing rate caps with risk-sharing mechanisms, subsidies, or public backstops to preserve access. Another suggests tiered caps linked to credit quality. A third suggests focusing on income stability and fraud reduction instead of headline pricing. None are simple. All require trade-offs. This is where the real debate lives, not in slogans, but in structure. Here's what nobody tells you. Banks aren't panicking because rates might fall. They're panicking because the system was built around them being high. Change the rule without rebuilding the foundation, and cracks spread fast. The proposal exposed something uncomfortable. Modern consumption leans heavily on expensive unsecured credit, because income's lag in volatility is normal. Credit cards didn't create that reality. They adapted to it. Cap the adaptation, and the underlying pressures surface. This isn't a story about villains or heroes. It's a story about incentives colliding with intentions. Not greed versus fairness. Mechanics versus desire. And mechanics always collect their due. The final outcome remains conditional. A cap could become relief if paired with structural reform. It could become exclusion if imposed alone. Or it could trigger a quiet reset, shrinking credit access while pushing households toward new, less visible forms of debt. The system will respond. It always does. The only unanswered question is where the pressure goes next, because once it leaves the interest rate, it doesn't disappear. It just finds a new place to break.